Crude prices were up yesterday amid Iran's ballistic missile attack on Israel. But this morning, Saudi's oil minister is warning fellow OPEC members that prices could plunge if countries don't abide by the group's production limits. We are talking about WTI at this point at $72. Brent is at $75.73. And joining us right now is Rebecca Babin, who is CIBC Private Wealth senior energy trader. Rebecca, I have to say, I'm actually surprised you're not seeing prices quite a bit higher from here. When you look at Iran having this complete number of hundreds of ballistic missiles falling on Israel, the IDF saying they're going to respond, and the U.S. saying it's going to back up Israel. I mean, it doesn't get much bigger than Iran and the United States getting pulled into this at the same time. Why do you think we haven't seen more of a response in the oil markets?
Yeah, so I think the key to that question is ultimately the amount of spare capacity that OPEC has on the sidelines. And you hinted at it in your lead-in. MBS made the comment that crude could fall to the 50s if they actually go after market share as opposed to supporting price. What that would mean is they bring back the million-plus barrels they have on the sideline, and they allow themselves to continue to increase production. So the spare capacity that OPEC has is over 4 million barrels a day sitting on the sidelines. So it would take a very significant supply disruption for OPEC Plus not to be able to fill that gap. And so the market looks at this event that's happened with Iran and Israel and says, there is a bigger chance that we have a supply disruption, but we're not as afraid of that tail event because we know there's a lot of crude sitting on the sidelines. And secondly, we know right now MBS and Saudi Arabia are very frustrated with their other OPEC Plus members for not complying to the production cuts over the past several years and are more willing to potentially release that supply back to the market if we do get a price spike than they have in the past. So I think that's the setup as to why crude is not seeing these huge kind of $10, $15 moves on an event like this, is ultimately there's a plenty of supply out there that can fill a gap. Now, can it fill that gap indefinitely? No. So there is a longer term big picture here that I think this could, if it does escalate and devolve into something much more significant, cause a meaningful kind of uptick over the long term to prices. But in the short term here, until we know what happens and the amount of supply that the market is comfortable with as a buffer to the upside, we're seeing a very kind of muted and measured response in crude oil.
Do you think the market just is not factoring in the idea that the Israelis could go after oil production, oil refining facilities in Iran? Is that a reality in your view, and is that factored into these prices?
I think it's a reality, and I think it is not entirely factored into the prices because if you look at historical events, particularly over the last 2 years, if you look at Russia's invasion of Ukraine and everything that's happened since October 7th, there's been these spikes of geopolitical events, and every single time it's not resulted in this supply disruption. Things have de-escalated or they've taken a different tact. So I think the market is kind of trained or desensitized to a certain extent to these events that supply will come off the market. So I think there is potentially the market playing chicken here with these events. I think there is a potential that Israel goes after Iran energy facilities. Keep in mind, that's 1.8 million barrels of crude exports that could be impacted. Again, I just said OPEC Plus has 4 million barrels of supply capacity, spare capacity sitting on the sidelines. So it is a real threat, but it might not potentially be as devastating if we didn't have that buffer of OPEC supply on the sidelines.
We haven't talked about demand at all because the reason that people have given to this point for oil prices not going higher is that demand from China was so weak. China just laid in massive stimulus plans to try and stimulate its economy. How does that factor into the market, and where should prices be as a result?
That's a great question. And if anything, I was very surprised. We saw industrial metals rally on China's stimulus, and we saw crude basically do nothing after stimulus was announced last week in China. And I think ultimately, when you look at the makeup of the Chinese economy and the stimulus they're kind of setting forth on, there's not a lot of confidence that we're going to see a massive increase in crude oil demand as a result. I challenge that. I think the market is absolutely underestimating the fact that Chinese demand will improve with stimulus, but the sentiment in crude right now is just tremendously sour. They don't think that China demand can improve. They think next year we look at a massively oversupplied market and nobody is willing to play upside in crude oil. If they think there's going to be stimulus, they're looking at the other industrial metals. And the key there, and I'm going to come back to it again, is the fact that we have this big buffer of supply sitting on top of crude from OPEC plus. So it's like, what's your upside, right? If I'm wrong and China demand doesn't improve, I've got this big downside tail, but my upside's kind of capped, right? Because there's all this supply. Maybe I'll look at copper. Maybe I'll look at another way to play that China trade. So crude's kind of been left behind as we saw that stimulus announced.